What's going on, Bat Fam? Welcome back to the Build a Trader YouTube channel. In this video, you're going to learn how to find highly probable trade entries for your trading setups. These concepts come off the last video, Intro to Candlesticks and Key Levels, and all these concepts are only going to build on top of each other. By the end of this video, you're going to learn how to find trade entries, highly probable trade entries for your highly probable trading setups. Now, I'm going to head to the charts. I'll see you guys there. And also, hope you guys enjoy the new intro.
All I do is daydream. They've been sleeping on us, I'm just trying to see what they...
What's going on, Bat Fam? Here we are on the chart. We're looking at the US dollar against the Japanese yen, USD JPY. Right now we are on the 30-minute time frame. And actually I'm going to go over 4 of these trades that I took this week. I lost 1 and won 3, so I went 3 and 4 on this pair this week. And I'm going to show you exactly how I found these trade entries and where I placed my stop loss. So, starting with the first trade here, and these are all the concepts that I just talked about: key levels, candlestick patterns, and now you're going to find out about trade entries and stop loss placement. So here's this first trade I took. You can see that I managed my risk down here. I actually had the stop loss lower down at this level. However, I cut my loss early, which is totally fine. You know, if you manage your risk early enough and take smaller losses, everything's okay. I'm gonna take a drink of this real quick. Shout out Alani energy drink. Let's go. All right. So the reason I took this trade is, one, I saw market behavior on the lower time frame as well as the higher time frame lining up with each other. And if you don't understand time frame correlation, you can watch my time frame correlation video. So I saw this bullish engulfing pattern, as well as this should be over like this here. I executed when I saw this bullish engulfing pattern and this candle break right here. The next candle, it had a little bit of drawdown and then closed as a pin bar or hammer type candle, if that's what you want to call it, and then continued up, but it didn't break higher. And in theory, on this setup, it should have went something like this. Perhaps went down and went up all the way here, but it didn't this time, and that's fine. You know, that happens in trading. You can't win every single trade. You just gotta execute and play the probabilities and manage your risk, and that's what I did here. In theory, this high should have broke and continue to make a higher high up here, but it didn't. It wanted to come down and retest this level here. The reason I had my stop loss down here originally, it was originally at 540, but I moved it up. But you can see it didn't even hit, which is okay. But it was because it was below a higher time frame structure point down here. In theory, if this level were to break, where I have this zone that I just drew, if this were to break, go down like that, then the whole bullish setup, the whole buy setup would be invalid. Market structure would be broken on the higher time frame and there'd be a momentum shift from bullish to bearish. But that didn't happen. This level ultimately was respected and made an exhaustion candle, as you can see. It continued all the way back up to there. So after seeing this behavior, after being stopped out and managing my risk, okay, I lost this trade. After managing my risk, I waited because I knew that, one, this level didn't break. 2, I knew that since it didn't break, we should continue bullish, and I also noticed the exhaustion down here. And if you watched the previous video, Intro to Candlestick Patterns and Key Levels, I talk about exhaustion a little bit. In these exhaustion wicks, these wicks, they're called wicks. There are lower time frame candlestick patterns, right? So they're either engulfing candles or they're double bottoms, double tops. You know, the reversal patterns or continuation patterns. You know, they can be viewed as the same thing depending on where they are in the market. Okay, so after I saw those wicks, I noticed that, as I was saying, there's a double bottom created, right? And if you don't see it, let me draw it out like this. And then continued up, right? Made a higher high. It broke this little area here, and this confirmed to me, like, okay, we're back to bullish again. So once I saw this pullback right here, this candle, I entered on this wick, and as you can see, I literally had next to no drawdown, and it was in profit almost instantly on this trade because of my understanding of the overall trend, time frame correlation, as well as using candlestick patterns and key levels. Okay, I'm going to remove these arrows. Where that double bottom was is also a level of support where this gray zone is. This gray zone is just to highlight those wicks on the previous time frame I was just on. But this is where this level is, a level of support, a minor key level on the lower time frame. And in theory, this needs to be respected and held in order for everything to line back up again, right? And as you can see, after that, it pushed higher, created a higher low point, and then ultimately pushed all the way back up to the original point where I was expecting price to go. You can see hit it to the T before coming back down. Okay, and I entered off that because one, the wick, the double bottom pattern, and understanding how market structure works, right? Because in the bullish market structure, it needs to make higher highs and higher lows. A double bottom is a bullish candle pattern. Just seeing it on a key level is bullish as well. That indicates that it's failing to break. It's failing to go lower, which means it is going to go higher. If something fails to go lower, it's going to go higher. It's simple as that. So we enter there, and you can see this take profit was hit. And I had a tight stop loss at 640. I had the stop loss here because it was below the structure point, below the candlesticks and below the exhaustion. Okay, if you can spot entries early enough and understand how the market behavior plays out on lower time frames and higher time frames, once again using time frame correlation and market structure, you can use the lower time frames to place your stop loss or manage your risk in a tighter area, or risking less essentially. And so, as you can see, as a result, it played out. And had I got stopped out, that would have been okay, because you have to play the probabilities and execute. The whole name of the game is managing risk and executing. If you don't execute, you can't make any money. It's as simple as that. So that's how I took that trade, and that's why I placed my stop loss there. Most of the time, or almost every single time, your stop loss is going to be placed based off structure. The only time it's not going to be placed off structure is if you're trading like a momentum candle or an impulse move. It's going to be below that previous candle because in theory, it'll make a higher high, right? So let me show you an example of that. This would be a good example of what I was talking about for a breakout or impulse move, because my stop loss was below the wick. These wicks was just the previous candle. This is a breakout. This is a breakout trade. The exact reason, the exact concept I was just talking about. So I took this trade one because I understood the behavior, like I was saying, and I actually closed right where it hit the resistance. Did not close up here because I noticed that there was a rejection. So yeah. Anyways, so I'm gonna mark these wicks up in this zone, and this is a candlestick pattern. These two wicks are, and it should be like a double bottom or something once again, or something similar. Yeah, this is a double bottom pattern. So what I noticed here was this. there's a level of resistance as well as market structure. So this is key level of resistance, and if this lower high breaks, or these wicks where it rejected and came down before breaking higher, if this breaks, in theory, it's going to make a higher high as such, which it did. If it had not broken this level, it would have went up like that and then rejected once again and came down. So I caught this momentum move, or this impulse leg, based off of two things: time frame correlation, market structure, right? That's what everything comes back to when you're a price action trader and using support and resistance and reading the candlesticks. So here I noticed there's a bullish engulfing candle, which is the wicks on the higher time frame. So understanding that rejection, I dropped down to the lower time frame and just simply executed. And as a result, it played out beautifully. And where it was on the break of this level. I noticed there's a lot of momentum, a lot of bullish pressure coming in based off of the lower time frames, as well as flipping back to the 30-minute and 1-hour time frame. And as you can see, once this previous candle high broke, and on the lower time frame it was structure, it took off all the way to the resistance. This was an easy trade, and you can catch these type of momentum trades very easily based off the concepts I just said. And obviously the stop loss is placed below the structure, below the wicks, and which is as well as the candle low. Because in theory, if it was going to break this wick, break this low, it would go lower, right? Because if the market breaks its low point, it's going to make a lower low. If the market breaks its high point, it's going to make a higher high. It's that simple. Last trade is this one right here. So I took this trade based off of same exact things: market structure, key levels, candlestick patterns. I noticed that there was a higher low formed here, and I noticed that the bullish momentum was still there was still a lot of buyers in the market. Essentially, I made a higher low point. There's a bullish engulfing candle. Market was still bullish overall, making higher highs and higher lows. Higher time frame overall trend was still bullish, and this candle right here is really important. This is called a pin bar or a inverted hammer. It depends what you want to call it, or a hammer candle, but I'm calling this a pin bar. This essentially signals to buyers that we're going up. This is a strong indication of bullish momentum most of the time, depending where it is. You can see kind of a similar candle right here, but it didn't work out because the context of where it's at. The point of being able to read candles and having key levels is to understand how they work with each other, and the candles and key levels need to be in context with one another, and if you're not reading it correctly, it's invalid. So things are more valid when they are on certain levels in certain areas, whereas when they are not on those levels in those certain areas. If that makes sense. So as you can see, as a result, there's this pin bar, and all of a sudden, boom, all this bullish momentum came in and just shot up to the upside. So I closed out this resistance up there, and as you can see, the resistance and key levels are basically the same thing. So as you can see, all these things, all these entries, all these take profits are based off key levels and candlestick patterns. Okay, the next video I'm gonna make, I'll talk about how to find your take profits and find these other key levels to line up with one another, so that you can continue to find these high probability trading setups as I'm showing you. I just showed you a 75% win rate in 1 week. Last week was a red week for me, but as you can see, if you manage your risk and trade high probability trading setups and stay patient and be disciplined, you'll win every single time. This week completely eradicated the week before, all because I took 4 high probability trade setups. It's literally that simple. And one more thing, I placed a stop loss down here because where this blue line is and where these candlesticks are right here, this is the major structure point. So if this point were to break, this were to break and continue lower, then it's no longer bullish, it'd be bearish. So understanding that, using market structure and key levels, that is why I placed my stop loss there. Now you could have made it even tighter, and could have made it tighter and placed it below this, but that had a high chance of getting stopped out. But your risk would have been managed tighter. You know, it depends how you want to trade. You could use more risk here, a bigger lot size here with a tighter stop loss, and if you would have got stopped out, that's fine, because it most likely would have been a normal loss. Even though you're using more, the way you want to manage risk is by risking the same amount, you know, by having tighter stop losses or wider stop losses and adjusting your position size and such. And I'll make a video on that after this one. You know, we're building a foundation here, so you got to understand the process. The most important thing is understanding the process before you start trading. As I've showed you how to find support and resistance, how to identify the trend using time frame correlation, how to find market structure using lower time frames, higher time frames. All this stuff goes together. And if you're watching these videos, you're really going to understand how to start trading and how to find these entries and how to manage your risk. And that's the most important thing. But that was basically all the examples I was trying to show you guys for this video. Just trade entries and managing your risk. All of these entries and stop loss placements were based off candlesticks, key levels, market structure. Very important concepts. They're always going to come back to each other. Thank you so much for staying around to the end of the video. Hope you guys learned something extremely valuable and that you guys learned how to find highly probable trade entries for your setups. I'll see you guys in the next video. Don't forget to like and subscribe. Peace.